Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. If 2020 was the big reset, then it indeed would be true that there is a start of a new set of trends from that point of reset. And what I mean is, there would be some trends that would have been underway because of the lockdown induced correction. These trends gave you an opportunity to make a fresh investment and therefore almost think of it as investing into a new trend. And if that is indeed the case, let's talk about some of these and the investability or the possibilities of investment into some of these trends. Vikas Khemani of Carnelian has been talking about some of these for the last 6 to 9 odd months, and two or three of them are turning out to be true very rather quickly. And that's why we thought it was best to get him on the show today to talk about how does he see the not the emergence really, but the strengthening of these trends as time goes by. Because good having you. Thanks for joining in. Hope all is safe.
Yes, Neeraj, thank you for having me. It's always great to chat with you.
Thank you so much, Vikas. So, Vikas, you essentially, as much as I know you and interacted with you over the years, you you try to identify trends which might have a longer gestation and try to get into them early. Now, let's talk about some of these trends. Some of it I've picked up from the newsletter that you guys have put up on your website as well, and try and figure out if indeed the markets at the current juncture at all-time highs give investors the opportunities to invest in them or no. Yeah. So technology. Give us your thesis of why you had initially liked technology. How is it shaping up, and how do you see outlook to be like?
Absolutely, Neeraj. So I think before I get to technology, I just want to say that reason why we do that I believe that if you catch a multi-year trend, your ability to play that out with conviction, I think multiplies. As we play in the market, there will be periods of volatility, there will be periods of disappointment. But if you have solid belief in the underlying theme or underlying sort of demand drivers at play, then you can stay put even through the volatile or bad phase of the market, because market would bring those phase. So I mean, and biggest amount of money, in my opinion, is made when you find those underlying sectors or trends with the tailwind, and then identify best companies in that. When you have combination of these, then you get a sort of double whammy or double turbocharge, so to say. So that's the very reason why we kind of spend a lot of time in thinking about them. But of course, you have to go and do your work at the stock level and company level. There's no denial of that. Now, coming to technology, I think we had a long chat about this, 3 4 months ago. Post COVID, there's a very big change which has happened. There's a more of technology in everybody's life, be it organization, be it society, government, individuals, right? And the way technology has been used or will be used is dramatically changed. While some of those trends have been underway over last 3 4 years, whether it is cloudification, digitization, they were happening. It's not that they were not happening. COVID had just brought a huge amount of urgency and speed to that transition. So if this was to happen over next 10 years, probably it will happen in next 3 or 4 years. And this big change, which is irreversible, whether tomorrow vaccine comes or not, because this is now about habits. This is not about this is about now needs, and this is non-discretionary in nature. And that's the reason we think the demand environment will remain very strong. And this is a global demand. This is, mind you, not a local demand. This is across the countries, it is across industries, and it is also government and private. And that makes it very unique. And another thing which makes it very, very interesting, Neeraj, is that this is the one sector where demand is global, but the supply is only local, only Indian companies. You will find, there's no match in this particular space, IT services for Indian companies, right? And there are only 8 10 meaningful Indian companies which can sort of cater to this kind of demand. And when you talk to these companies, you find that there's a sudden rush of the orders, and in fact, to the extent that these are companies are not able to even cope up with the sort of inflow of inquiries. And that's the kind of environment we are talking about. So we believe that this will remain like this over next 3 4 years. And another interesting part about this sector is that it's a cash flow positive sector, does not require capital, very well managed companies, ESG scores are very high. So we think that this is a multi-year wealth creation opportunities which is available to India. And this will also have an impact at the India level, in terms of addressing your current account deficit, as well as creating huge amount of employment in the economy. As you know that 50 to 60% of the IT revenues go into salaries. So to that extent, more jobs will be created, and that will also have a multiplier impact on the impact in economy. So we find technology is a very big sort of sector. And you would know, I tweeted some time ago that uh, technology sector will surpass banking market cap, and we've already seen that technology sector is higher than market cap of the banking sector. And so hence it should be seen as a very significant enabler, and we think it's going to be very interesting sector to sort of play out.
Mm. Because the earlier conversation that we had, you had referred to the point of multiples moving up from where they were then, which was about 6 to 9 months ago. Now you've seen 2 quarters of earnings post that, you've seen 2 quarters of commentary post that, and you would have had your own conversations with some of these companies, large, mid, and small. From where we are right now, do you reckon there is room for valuations to move significantly higher, or would growth in investments be a factor of earnings growth? That is part one of my question. Part two of my question is, would you believe that this can happen across the market cap spectrum, or do you believe that the larger companies are the best bet?
So I think very good questions, Neeraj. I think, like we said, when we spoke about 2 quarters ago, we said that earnings multiples will expand, right? And we have already seen some sort of expansion in play. But I feel it's only job half done. For the simple reason, still large part of the investors are still non-believers in this. Many investors are still not overweight on this. And this is like, in my opinion, if you just look at how different this sector is than an FMCG or a consumer play. Whereas most of the stocks trade at 40 times, 50 times, 60 times, whereas these kind of companies have pretty much similar kind of, or in fact in terms sometimes better than high ROEs, high cash flow conversion, and better demand. So as the time passes, the confidence will keep coming, and you will see further expansion of the multiples. My sense, again, there's no science to this, but my sense is that as the time passes and more conviction builds around the sector, you will see probably most of the IT sectors trading around 40 times earning multiple, and that will further create value. And coming to a question of mid cap and large cap, see, when this kind of strong environment happens, companies across the straddle benefits, because today companies like TCS and Infosys and HCL cannot attend to a lot of smaller companies' demand. For the simple reason because they are busy doing larger contracts. Now that will create a significant opportunities for the smaller size companies. And we have seen, and those kind of companies will also they do have capability, but as the good strong environment comes about, they will go and address, and on a smaller base the growth would be interesting. So you might see some of the mid cap companies will migrate to large cap in this cycle. Companies like Mindtree have a good shot to migrate into large cap. We have already seen companies like L&T Info has done very well. So same way small cap companies might migrate to mid cap. You will see that pretty much happening in front of our eyes over next 2 to 3 years.
Hmm. Well, viewers, one of the things that somebody told me, if you can't be a tech company employee, be a shareholder, at least that way you're participating in this upsurge that we're seeing. Because
Absolutely.
I'll take a leaf out of your answer, wherein you said that technology market cap eclipsing banking, but you also believe BFSI is a mega theme too. Now, it's been the largest space in terms of weighted for a while now on the indices. Why do you believe there is a re-emergence of the trend? And whether will it be B, will it benefit out of this, or will it be the FI which will benefit out of this?
So I think again, this is one of the sector. If you see, Neeraj, banking has been going through a huge amount of pain over last 3 4 years, especially after ILFS crisis, and COVID probably added to it. And in this period, I think you saw the entire corporate credit cycle, the provisioning, recapitalization, all those things have kind of been done. So what the way we see is that, especially when banking credit comes, by and large, the pain is behind in terms of whether we have to provide NPAs or capitalization. Most of the pain is behind. Some might continue still, but most of it. And banking sector is set here now to sort of start growing. And the way we see is that, in fact, markets expectation on corporate credit growth is very poor. According to us, we will get positively surprised over next 2 3 years in that. So we are quite positive about credit side where the growth will come. So you actually had earlier degrowth, balance sheet sort of what do you call cleaning up, recapitalization. From here now you will start seeing a very very balanced growth, and most of the PSU banks are now consolidated in few ones. So as we see, you will see some of the the core industry which created a pain like steel and real estate are coming back. So all those things will have a fairly positive impact on the banking sector, and we do think that and banking is such a core to any economic growth, and without that you cannot have economic growth coming through. So we are quite optimistic about the credit growth environment, and you will see the banking sector doing very well over the next 3 to 5 years, and even beyond that. And even the non-credit side, the structural drivers of the growth, or whether it is insurance, life insurance, general insurance, AMCs. I mean, we are so much underpenetrated that as the per capita income grows up, as the growth goes up, those sectors will have a natural growth. So I think if you look at the entire BFSI basket, you will definitely see a good compounding going. So, interesting part I like about India right now, and we'll talk more about that. We will see lots of drivers of economic growth in India.
Yeah, we will. Just a follow up there, because here, because there is such a widespread sector, what is your pecking order? I'm presuming that you do not have to conform to the index weightages, and therefore your positioning in banking could be completely different from the weightage that BFSI has on the Nifty, for example. So therefore, since you have that choice, would a large insurance company have a higher weightage compared to a large banking name, maybe compared to a large NBFC? How is the pecking order there? And out here, would you believe that the larger ones will probably stand to benefit more? It may not be true in technology, but could it be true in BFSI?
Absolutely. I think banking is one sector where big will become bigger. The smaller guys will kind of struggle, because in this, typically people would like to deal with banks with a bigger balance sheet side, better governance, better ability to serve, better technology profile, and which by nature, I think larger companies would be able to, deliver better. And hence, so and our choice has been, around. So the way we look at BFSI is credit and non-credit, and we try to keep a reasonably good balance between two, because non-credit provides less volatility but good growth. Credit has good growth but sometimes can be a little bit volatile depending on how the macro factors play out. So currently we are a little bit more tilted in favor of credit within our overweight of BFSI. But I think that those tactical allocations you can keep changing depending on what's your macro view of the market. But otherwise, I think that BFSI across the board, larger companies will deliver, 16, 18% return consistently over next 3 to 5 years. And, credit might even surprise you on the upside as the environment sort of picks up.
There is a bit of a valuation differential, though, because between the larger ones as well, right? But it has existed all through. So in banking, HDFC and Kotak command a substantially higher premium as compared to, say, for example, an ICICI or an Axis. And then, of course, the other rung names, and there is an SBI thrown in there as well. So just last question on this BFSI piece. Within that, do you find favor in the high quality but very high valuation banks, or would you prefer the latter ones?
No, so I think we prefer, some of the names like you mentioned, ICICI Bank and Axis and all, because we think that they are also incredible franchises. I think, of course, they had their history and some bit of a past, and because of that, they do trade at a discount. But some of the transformative work these managements are doing, we think that there will be bridging of the valuation gap between, the top tier and, maybe you can call it tier two, or the little lesser valued banks. And as you see that bridging, you will see probably re-rating happening, and hence returns can come from both earnings growth as well as the re-rating. So we prefer that. But having said that, even Kotak's and HDFC's, the larger franchise, will continue to grow, because the sheer platform, sheer network, sheer the tailwind in the sector itself, provides you growth. You don't have to do anything stupid in this period. Just keep doing things simple. I think growth will come by. I mean, this is how at least we see in banking.
Then it's an easy call, right? As long as you bet on something which is not doing too many stupid things, you has tend to
Absolutely.
gain, uh, create wealth for yourself. Um, you've been talking about real estate now for the last 3 years. You must be happy with the way things are finally shaping up in the last 6 to 9 odd months, right? Because um, what's your sense? Have the stocks done too much too soon, or do you reckon this is just the start?
Well, I think we believe that it's a very, very early start of the, a decadal trend because see, real estate is core part to any economy. In India, it has been because of the historical reason of a very unorganized nature of the sector. We could never see, sector doing well, getting organized, attracting capital. But if you see in last 2 years, the amount of capital it has attracted, especially on the commercial side, lots of foreign capital has come and kind of grabbed spaces. So this is beginning of that, and post RERA implementation, we think that only good quality developers with well capitalized balance sheet, good execution capability will only be able to survive. Customers are well protected. There are a lot of customer rights. So whenever this kind of thing happens to any sector, like it happened in insurance, it happened into capital markets, it happened into banking. So a regulator provides a huge amount of boost to the growth because with that, good and large players can come and commit serious growth capital. That's what we are going to see in this. So it will be win-win for customers and win-win for some of the large capitalized and good players. And you will see, today real estate market cap in India is less than 1% of the total market cap, which is like hardly anything. And you will see that over a year it could be 5%, 7%, 10%, depending on how things pan out. But we do definitely see it's a in a shorter term it might look like that things have gone up, but as I said earlier that when you believe in a trend for 10 years, then I think you can stay put and you don't have to worry about day-to-day price movements, whether it is overdone in the short term, underdone. You just kind of stay put, and if you allocate capital over a medium period to longer period, you come out very, very strong.
Mm. Yep, a few listed plays out here, viewers. The choices should be easy if you indeed believe in the arguments Vikas is making. Because the last point, and that is on what you alluded to as well, multiple spheres of growth in the Indian economy, and the space or the ubiquitous pocket that benefits out of it is manufacturing, isn't it? All forms. It's come to the fore in a big way. I reckon you believe it is just a start. But so let me draft my question here. You explained to us in the last conversation that we did, why do you believe manufacturing is a great team? So we kind of have that idea. Can I ask you to elaborate on what within manufacturing do you believe will be the first amongst equals, so to say? What are those one or two or three themes that you believe actually have a higher chance of having a much larger success than the others? Everything will do well, but surely there will be some which will do better.
So I think if you see two things what was happening. One is the spaces where India was hugely dependent on imports, because I think import substitution is a very big focus by the Indian government. And there are lots of support being given, and from a risk mitigation perspective, and so you have tariff support and non-tariff support, and that is I think creating sizable opportunities, and that spreads across chemicals, APIs, auto and defense, across various capital goods. It spreads across these themes, and same segment in electronics, consumer electronics. So that can create and we have already seen some of the stocks doing phenomenally well, but we believe that that's a start of early start of a big trend. And same thing, very the fact that you are going to be able to build here a scale manufacturing ecosystem, same very players will be in some time down the line will be ready for exports. Some of the sectors that we are already good at, we are seeing exports picking up. So this is a very interesting combination of meeting local demand, which itself is a very large sort of segment in India, plus combine it with the export demand. So this kind of ecosystem will drive to create a massive scale manufacturing, capabilities across all the segments we talked about, and many more will come. Because this is an evolving sector, you will suddenly surprised to know that this sector also can India do well? I mean, something like toy manufacturing, something like footwear manufacturing, they are all not there right now. But can they become in 3, 5 years down the line? Very big answer is yes. So one has to keep eye on that what sectors are going to kind of sort of come about in this, or what opportunities are going to come about this. But one thing we are picking up with reasonably high amount of confidence that as India's manufacturing GDP sort of doubles or more than doubles from $450 billion to $1.5 trillion, you will see a massive investment cycle picking up. You will see a massive sort of scale up in the revenue and profitability of some of these companies. And more importantly, Neeraj, like I was talking about earlier, this will have a multiplier effect. More job creation, investment cycle picking up, also has a multiplier effect, both on banking, on a lot of like sectors. And if I combine this with again impact of addressing the current account deficit of the country, this IT put together can have a huge impact on the growth profile of the country, on the macro current account deficit profile of the country, which will enable us to keep our interest rates low for a long period of time. And this is the reason why we think that this is a multi-year bull run. The structural parameters of the Indian economy is getting into place. When I make this point, does not mean that there won't be volatility in the market. All those things will usually happen. But the perspective one has to see, according to me, is that the macro impact of some of these pieces which are getting developed can put into India into a very different trajectory. And when we have a very solid and sustainable growth, including macro being in the place, uh, I think we can have a serious opportunity ahead of us. Mind you, every time India had to increase interest rates or any shock, it came only from current account deficit side, right? Well, most of the period, if you go and look back. So if that part is getting addressed, the ability to keep interest rate low for a long period of time will be very high. And this single factor, if you ask me, makes me very sort of confident that interest rates can remain low and this rally can sustain.
Hmm. Because I'll pick up two pockets as the final piece of the conversation from this that you've mentioned, and both have had divergent fortunes in the last 10 years. Pharma, and nobody doubts that we are the pharmacy of the world, so to say, and textiles, wherein we seem to have lost the playground to countries like Bangladesh and Vietnam. You list both of these as potential beneficiaries of the manufacturing boom, super cycle, whatever you call. Can you elaborate on both?
So again, pharmaceutical, like you said, we've always had capability, and we will continue to, I think, sort of do well on that. You would have seen it came out of a very long period of a difficult period. We are now seeing, new structural drivers of the growth there. Especially U.S. markets have opened up. Also, I think there's a huge amount of investments happening into APIs from a backward integration perspective. So I think we will have an interesting phase of, this whole sector, pharma APIs, over next 5-7 years. If you were to also see the early indicators, the amount of PE activity which has happened into pharma companies is also not small. I mean, lots of PE guys have been buying large pharma companies and to grow. So that also gives you some amount of indications on the what's in store for a domestic growth also. So you have a again twin driver of domestic growth as India's healthcare system sort of gets better and spend increases. Also coupled with that is you have export, which is now doing well. So we think it's going to sort of sustain from here. Uh, you know, and I think on the other sectors we mentioned textile. While yes, we have lost bus to countries like Bangladesh in Vietnam, but I think if you look at there also some of the there are lots of efforts being made by government. They have recently announced that they are opening 6 textile parks to create the ecosystem, to tap that opportunity. But yes, we are behind in that, but we think that if you talk to companies like KPR Mills and who are in the middle of this, they are saying demand environment is very robust as long as we can cater to that in a good manner. So whenever demand environment is there, I do believe that Indian entrepreneurs will figure out how to meet to that. And government is also being very supportive. And this is the one sector which is huge employment generative sector. So I am quite hopeful that things will pan out well in this. Some of the existing companies are already expanding and they have announced big capex plans. That is a lead indicator about how they are feeling about the sector. But will we get into the league of Bangladesh and Vietnam anytime soon? Maybe it's not. But again, everything we may not get it right, but as long as I think directionally things are going well, we are quite okay.
Hmm. Okay, because this was helpful. I mean, the indices may do what they do, but if you invest in megatrends, viewers, likely that over a period of time you will create substantial wealth. Thanks so much, Vikas, for joining in today and giving us some sense of some of the megatrends that you've enlisted in your blogs.
Thank you very much, Neeraj. It was lovely chatting with you as always.
As always, thank you so much, Vikas. And viewers, thanks for tuning into this leg of the Talking Point.